It's important to have a feedback loop where you're constantly thinking about what you've done and how you could be doing better. And the reason this is so important, because if you're just taking random actions and expecting to get improved results, there's no feedback mechanism to say, hey, this action led to a better result. And you're just kind of floundering in the dark and unable to actually analyze your results properly because you're taking inconsistent actions. The goal with trading is to make money over time. Our inputs are stock selection, position sizing, entries, exits, our full system. Our outputs are trade results, our performance. But what's very difficult about trading is that there are a lot of external factors at play. So there's the market environment, news catalysts, tweets, Fed meetings. All these can impact whether a trade or a series of trades is successful over time. So first, data collection. There's a few different things you can do. You could keep a daily journal / check-in where you track your trades and note them at the end of the day. Then on a per trade basis, you could have a sample trade input form, or you can import it from your broker. But the main thing is that you want to make it seamless, make it easy, so you actually do this. So you have your data. Now what? Basically, you want to organize by trade, calculate key metrics, create visualizations, compare to historical norms, and then basically become a detective and draw conclusions based on your data itself. Batting average, like I said, is your percent of your trades that are wins. So if you have 20 trades over a period and 10 are wins, you've got a 50% win rate or batting average. If you have 10 trades and you have 3 wins, you've got a 30% batting average. Here's the histogram performance. Basically, this is using a sample size of over, say, the last month. This here on the bottom is basically the percent gain on the trade. And then this here on the left-hand side is the frequency. This is exactly kind of what you want to see for a good system. So this is a good example. You've got most of your losses right near the left side of 0. And then you've got some really strong trades that are really working for you and moving the needle. All right. Well, let's go ahead and get started, everybody. So welcome again to another Trader's Handbook webinar. Today, we're diving into the post-analysis section. This entire weekend is post-analysis. Today is focused on trading analytics. Tomorrow will be focused on analyzing individual trades, assessing where you bought, where you sold, what improvements you can make, and tweaks to your rules. And, this whole weekend, I think, comes together really nicely and is key to kind of building in a feedback loop. We'll talk about that quite a bit today, about, creating a feedback loop that allows us to improve over time. That's, of course, the goal. We want to be improving with every market cycle, almost, every month that we trade. And a feedback loop and post-analysis is critical to achieving that goal. Just a quick reminder here, if you haven't already, make sure to join the Trader's Handbook list. I'll be sending out the trade analytics log that you'll see as an example later on today to everybody who's on the list. So if you're not already on this, make sure to scan the QR code and join that. It's pretty quick and easy and gives you access to all these additional bonus articles. Also, definitely want to emphasize to pick up your Trader's Handbook as soon as you can if you haven't already. If you want it on the release day, you definitely want to order it quickly. We've gotten so much great feedback. We've had thousands of people submit their receipts and get access to bonus material. We'll be sending those out shortly, but make sure you pick it up and you can scan this QR code right here to do that. Here's a quick review from Deepak Upal. You probably know him from podcasts and presentations he's done in the past. We've also sent out and gotten positive reviews from a lot of great folks, Mark Minervini, Stan Weinstein, but this is just highlighting, a good summary of, the benefits of picking up the Trader's Handbook. He emphasizes that it draws from the strategies and principles used by some of the world's top traders and distills complex concepts into actionable steps that traders of all levels can understand and implement, and highlights the model book chart here as well. And this is really good to see. This is our overall goal, to save you time, help you along your trading journey. And Deepak mentions here, it would have saved me a lot of time and cost mistakes if he had picked up this book early on in his trading career. So definitely pick this up and let us know in the chat right now if you've already pre-ordered your copy. All right. Also, we've got a special offer. This will be the last time that we offer this. If you pick up the Trader's Handbook by the end of this weekend, you'll receive a $100 TraderLion gift card. Again, all you have to do is pre-order the book and then submit proof, and you can scan here to go ahead and do that. So again, if you want a $100 TraderLion gift card valid towards a masterclass or other TraderLion offering, make sure to pick up your copy here as well. I see a lot of people in the chat saying pre-ordered already, which is awesome. So great to see that for sure. All right. And it's pretty cool. It's coming out, I think, in exactly 10 days pretty much from today. So coming out very soon. Also, I really want to emphasize this. This is more than just a book. What you get when you pre-order is you get an entire educational course that includes the webinars that we're doing right now, bonus articles and guides, the companion workbook, the weekly charts model book, the base breakouts model book, the sell rules model book, the market cycles model book, an exclusive Q&A with us, the TraderLion founders. And in addition to that, you also get bonus webinars right here, really focused on key setups for momentum trading. These are base breakout setups, earnings gapper setups. We just did this one this past week, got great response. And next week, we'll be doing the trading pullbacks webinar. So these are excellent, and you only get this for ordering and submitting proof. So make sure to get yours in if you haven't already. And if you've attended some of these webinars, let us know in the chat if you've enjoyed them and find a lot of value in them. I know we got a lot of great feedback as we did them live, but I think the model books and these exclusive webinars by themselves are amazing resources, and you only get them through pre-ordering the Trader's Handbook. All right. And just want to emphasize again, the advanced pullback strategies will be this upcoming Wednesday. So make sure to pre-order and you'll be eligible to join right here. All right. And yeah, the gift card is eligible to be used on the Trade Lab, not DFU. And the bonuses will be sent out through email. If you've received a confirmation, you're good to go. But if you haven't already, make sure to submit your receipt. The link is in the description where you can submit your receipt. And Ryan, maybe you could drop that link as well one more time in the link in the chat here. All right. Okay. So with all that said, let's dive right into today. So again, welcome everybody to another Trader's Handbook webinar. Today we'll be focusing on trading analytics and journaling trades. This will be a little bit of a quicker topic, but there's a lot to cover. And like I said, it's very important to build up this feedback loop in order to actually improve as traders. So this dives into chapter 10. And like I said before, or I've said before, all these webinars build on and complement key chapters within the Trader's Handbook. And this chapter 10 is kind of my personal favorite, covering post analysis, how to actually calculate metrics, how to actually, analyze your results, all of that. So let's go ahead and dive right in. First, I want to start with this quick quote here from Elon Musk. It's important to have a feedback loop where you're constantly thinking about what you've done and how you could be doing better. And the reason this is so important, because if you're just taking random actions, we've talked about building consistency in the past. If you're just taking random actions and expecting to get improved results, there's no feedback mechanism to say, hey, this action led to a better result. And you're just kind of floundering in the dark and unable to actually analyze your results properly because you're taking inconsistent actions. So it's so important to have this feedback loop in addition to having an established system to start with, and then you build in, this mechanism where you analyze the outcomes and decide if any tweaks you made to your system actually improved the outcomes over time, or you should just go back to the drawing board and maybe try something else. And we'll get into the details here of this concept as well. So this is, Ryan and I are both engineering backgrounds. This is a very familiar diagram if you've taken any engineering classes. Basically, you have an input to a system. You have, your rules or the system itself. You have external factors, disturbances that impact the results of the steps taken by that system. And then you have an output. And this loop right here is what we're really talking about today. This is the feedback loop. And basically, this is where you take the output and put it back into a process where you analyze the outcomes based on how your system performs, and then use that to tweak your system and tweak the inputs that you make into the system. And the reason that this is so important is because if you don't have this feedback loop, again, you would just have this input, disturbance, and output. There'd be no mechanism to actually analyze yourself, analyze the outcomes of whatever inputs you had. And again, you'd just be floundering in space and unable to really improve because you don't have that mechanism to analyze yourself. And I want to make this slide here, how do we learn and improve? We make an action based on our current process and then see what the outcome is. And then based on that outcome and our analysis of the process, we can tweak the process and make another iteration and see if anything changed. And if the tweak improves the next outcome or outcomes, the tweak was a positive one, and that becomes the new process. If it does not, we can then try another tweak, and over time this leads to an improving process over the long term. But what's essential here, and what I just kind of mentioned, is what's essential is the analysis of the outcome step, the feedback loop. Without it, we are lost in terms of tweaks or our current system is working or not. And what is also crucial is we keep the inputs and actions from the system consistent. Otherwise, changes in the outcome cannot be properly attributed to tweaks of the system. We want to keep the inputs consistent because otherwise we don't know if those external factors that improved our results or just simply tweaks to the system. And to bring this all together, because I know that's kind of high level here, I want to give an example of something Rai is really good at, basketball, and shooting a bucket. Right, this is very simple. To shoot a bucket, say you're shooting a 3-pointer, you can launch the ball at a certain angle, that's an input, and a certain force, that's another input. And based on those two metrics, and based on the distance you are from the bucket, your shot will miss or make it. So say you undershoot the ball. How do you actually go ahead and prove it? Well, you want to notice by how much you are missing the target and basically recalibrate the angle you're shooting or the force you're shooting, again, your inputs and your system, to shoot a little bit further and eventually make it into the bucket. But again, if you don't have that feedback loop where maybe there's a wall right here and you can't see the outcome, there's no way to assess whether tweaks, shooting it harder, shooting it lower, shooting it higher, are actually, leading to improved outcomes, making more buckets. So you need to be able to analyze, where the ball fell relative to the bucket, and how this relates to trading is you have to be analyzing your results and assessing whether what you're doing, your system, your process, your rules are actually helping you or hurting you in the current market by analyzing your actual performance. So this just is a very simple system. But what's difficult about trading is that there's a complex system, and this is where the difficulty lies with post-analysis. Obviously, our goal, just like to make a basket, is to get the ball in the hoop. The goal with trading is to make money over time. Our inputs are stock selection, position sizing, entries, exits, our full system. Our outputs are trade results, our performance. But what's very difficult about trading is that there are a lot of external factors at play. So there's the market environment, news catalysts, tweets, Fed meetings. All these can impact whether a trade or a series of trades is successful over time. So it's not as simple as this system where, the only thing that really controls it is the force and angle of your shot, and then maybe there's some wind involved here. Maybe the type of ball is the weight of the ball is a factor. But trading is just much more complex, and that's why it's such an amazing challenge, and that's why there's also just such an amazing opportunity. So the key point is that it's very hard to directly attribute outputs to any one input when it comes to such a complex system. So we really have to be very procedural about this. We have to be systematic, and we have to analyze, over long series of trades to really get to the meat of if any tweaks we did actually are improving our process. All right, so how do we set up a trading feedback loop? Well, there's kind of two main aspects of it. Today's is really focused on trade analytics, taking it from a high-level perspective, and then tomorrow, the next webinar is focused on individual trade reviews, which is from a lower level, individual trade level, how you're processing things. So first, from a trade analytics level, again, you want to assess your overall performance and trends in your equity curve. You want to do data visualizations on your trade performance. You want to identify any system-level weaknesses or improvements you can likely make. Then, from an individual trade review level, obviously, you want to analyze kind of your system execution. Did you follow your buy rule? Did you follow your sell rule? And then identify any execution weaknesses or improvements. And, on an individual trade level, see, could there be any tweaks I can make to my rules to then improve my process? But, this is much more high level, and this is a little bit lower level. And Rai, I recognize that I haven't let you talked about the importance of post-analysis in general. Any thoughts on why it's so important to analyze your trades, analyze individual trade reviews to get that feedback loop?
Yeah, in anything that you do, you want to look back and see what the results are at the end of the day. And many traders, especially the phase 1 and 2 traders that we often talk to or do webinars for, they miss this most important part of looking at what happened and why it happened, right? Trading analytics initially, especially in your first few years, all the way to, I would say, up to a decade, is likely the most important thing that you will do to improve, improve and not make the same mistakes again and again. Many traders tend to do that, and I've been through the same where I feel like something will happen at some time where I will just be a different trader when I wake up the next day, while the results for many years remained exactly the same. And what changed that was to look at what I'm doing, why I'm placing the trades that I'm placing, why am I not improving, and kind of seeing, periods of really good returns, but then giving it all back in the markets. And then the difference, or where it clicked, was the fact that you actually go and analyze every single trade that you've placed, why you've placed it, what was the outcome of those trades, and why that outcome could have been different if you acted this, in scenario A or B differently. So it's all about self-assessment, looking internally, looking at your stats, looking at exactly ways to list down, hey, I need to improve at this. I'm not good at trading, let's say in the middle of the day to catch a trend reversal. I'm not good at trading, let's say, when the market has news associated with it. I'm not good at trading when the market is simply below the 50-day. So those observations will all come from the fact that you're doing, a deep dive into what trades you've placed, where you've placed them, and especially the losing trades, which will give you the most amount of input. And then when you're actually, you can curb your losses and you're improving from that front, then it becomes about why am I not holding the winners long enough as well. So it's a whole journey in and of itself, but what's important is to look at each thing that you're doing, each trade that you're placing, and that's, I think, something that phase one, phase two traders miss, and it takes them quite a while to get that consistency or phase three or performance from the markets and their numbers.
And how often do you think, especially beginner traders, should take a look at their data and keep tabs on their performance, study their equity curve? What would be a good kind of cadence every week, every month? What would be kind of your thoughts there?
I think in the beginning, doing more is much better. Later on, you could do once a quarter, once a month type of thing. But initially, if you're stage 1 and 2 and you haven't figured it out, you're a boom bust. Essentially, basically you're having those moves to the upside and then you're giving it all back. It's best to do that weekly. If you have a large down day, to do it that particular day. Also have a list of weaknesses, right? So there are certain situations like you'll see traders say that I don't trade biotech, I don't trade China stocks, I don't trade this, oil and gas, I don't trade. Those are factors where they're listing out their weaknesses, right? Some people are really good at looking at the fundamental situation and making a great assessment of where the market's headed, and then some people are really great at technical assessment of the markets and being really good at that. So finding your weaknesses is really important because it allows you to eliminate situations where you're supposed to be trading and not supposed to be trading in the markets as well. And then all that comes down to, going through, let's say you trade the bond market for 3 months and you figure out that, this is not for you because it's not achieving your objective. Well, that's something that you just, know in the back of your head, or you write down and you say, okay, I don't like participating in this type of market. I know traders that only trade gold, and they've mastered the gold trade. That's all they do. Look at the gold charts, gold futures. They wake up, they day trade them, swing trade them, position trade them, and that they know that market really well, how currencies influence that, how headlines influence it, etc. Right? So it's all about. I think that's most important. A lot of us, when we begin, want to do everything at once. We want, when companies in the retail space are doing well, along with Bank of America type of stocks, but then we want to be in those stocks. When growth is out of favor, we want to do something else. And usually that's not the best way for you to kind of excel and be great at something. So you have to pick a few spots where, a few good moves that you have in the markets, a few good moments that you feel you could trade really well. And then for us, me and Richard, that's growth stocks, right? We're looking at high potential growth stocks that can double and triple from potential entry areas while we keep our risk really, really low. That means that we're not trading REITs. That means we're not trading banking stocks for the most part. We're not trading utilities. So we've figured out, okay, these segments of the market fit the criteria of what we're trying to achieve, and these are the segments that can ignore. And usually those, as you gain more experience, will become times where you take time off from the markets when, Levi jeans is going up and people think jeans are a new innovation thing. Whereas some company that comes up in the AI space or the semi space is now innovating and doing something crazy that will, help us from a technological perspective. So those are two different ways, and so you got to pick those and make sure you're clear about them. And that all comes from, analyzing your trades at the end of the day.
Yeah, and just to tell a quick story, the first time I ever did post analysis, it was part of the class I did with Dr. Wish when I first learned how to trade. And this is very early in 2019. And I had done trades, I had gotten results, but, until I actually looked at the data, I didn't recognize I was making the same mistake over and over again and looking actually at the charts. And the mistake I was making is I was entering probably 2-3 days late in the right stocks. So the right stocks that went up 20, 30, 40%, whatever, and in the strong uptrend, I was entering the right stocks, but at the wrong time. And until I recognized that I was buying, after it was already short-term extended and getting shaken out on a natural pullback, maybe to the moving average, I would just get shaken out of those stocks. And so what I changed after that realization is buying a lot closer to the 21 EMA, the contraction, the actual kind of start of the breakout move, the momentum burst, people call it, Pradeep Bande. But if I hadn't actually looked at my performance and done the dirty work and actually went through different trades, I would have made the realization. There'd be no way for me to recognize just by, some magic perception that I was entering late all the time. I was just frustrated because I was getting shaken out and then the stocks would go out without me. So if there's a similar frustration that you're experiencing, oh, I get shaken out all the time. Oh, my sell rule gets me out and then the stock doubles from there. Actually go ahead and plot it on the chart and look at the data in your spreadsheet and see what you need to change. A later change that post analysis helped me with is I recognized I was in the right stocks and they were making strong moves with me, but I wasn't getting enough size in them for actually them to make an impact, because in order to actually improve your equity curve, there's both the weight of your position size and then there's the performance of the stock. And if the performance of your stock is great, but your weight is only 8%, 10%, you're not going to get that performance, that nice move that actually, helps you out and boosts your equity curve. So that's an improvement I had to make, where I boosted my weight, my position sizing, and that helped me during the stronger periods. So there's just a few examples about how post-analysis can help you. There's stories of many market wizards where they were frustrated, maybe early on in their trading careers, they weren't having the success they wanted, they blew up accounts, and then what did they do? They went back and analyzed every single trade they made over a year, 2 years, and identified their weaknesses and created rules and steps to improve on those weaknesses. And that's what turned around their performance. So this is really critical, guys. This might be tedious or whatever, but it's really what's going to be the biggest lever to moving you from stage 2 to stage 3 is recognizing the weaknesses you're making, especially regarding risk management or profit taking rules, and actually working to fix them. All right. So here's the actual agenda for today a little bit. We already talked about the importance of having a post-analysis feedback loop, but we're going to talk about some different key metrics to track, how to actually collect data. I think a lot of people just say, track your trades, but what does that actually mean? And how do we make it seamless so it actually gets done, right? Then we'll talk a little bit about a trade log. We'll be sending you guys a bonus template later today, the same one, I'll be showing later on. We'll talk a little bit about equity curve analysis, performance distribution visuals, and some other visuals you can make on your data. And then some few ideas of, again, how do you identify the weaknesses by doing different studies on your data and seeing if tweaks you make to your actual trades would have actually helped you. So this is the general agenda for today. All right. So first, data collection. There's a few different things you can do. You could keep a daily journal / check-in where you track your trades and note them at the end of the day. Then on a per trade basis, you could have a sample trade input form. And we're going to show an exact example of this later on. Or you can import it from your broker. I know there's software out there. We'll be creating something with DeepView. Maybe by the time you guys are watching this recording, we'll have that journal up and running. But the main thing is that you want to make it seamless, make it easy, so you actually do this, right? We don't want to say we're going to do this extensive post analysis and do it once and never do it again, because consistent tweaks to your process is better than trying to do everything all at once and just getting overwhelmed and never looking at it again. You don't want to hate the data collection process. You want to make it as easy as possible. All right. So this is a quick example of a trade input form that you can make after every single trade. So let me go ahead and zoom in here and we'll go through the sections. And this QR code, by the way, you can scan that and it will actually show you this right here. And then you could copy it very simply in Google Forms. This is actually how I created this. And what's great about Google Forms is that you can actually log the data in a Google Sheets for you. So it actually kind of does a lot of that data collection and preparation process for you. But basically, you'd have a few questions that you'd want to answer with any trade that you create. What was the stock symbol? What was the setup you used? Base breakout, gap, or pullback? That might be something to track. You could also have an entry tactic drop down list here where you'd select one of those. Then you'd want to, of course, put in your average costs, the number of shares, your initial stop loss level. And I think I added this one just because it might be really interesting to look back at how this impacts the actual performance of the trade. How confident do you feel about this trade just from 1 to 10? And, this would be some cool data to collect over time and say, over the course of 3 months, trades where I had an 8 or higher, I made, 12% on average, while trades 5 or below, I only made, 3% or actually lost money. This would be cool data to collect. So again, just with this trade input form, you want to make this quick and easy. You want to have it, be able to fill it out in under 3 minutes. But you want to, collect all the data that would be helpful for you going back and actually tracking your trade. And then here, just any additional notes about the trade, maybe some thoughts about the setup, anything you want to remind yourself of when you go back and actually analyze this trade on an individual basis. So again, this is a Google form. And you can set this up really easily. These are all just kind of long answer paragraph inputs. This is a drop down input, and you can actually scan this and you'll get, let me zoom out here. You can actually see this for you and create your own Google form that matches this. So this is a trade input form. Again, this would be one way to collect your data. Then another way would be to do more of a daily level, a daily journal. This is the one that I use, and I track my stuff using this. Basically, I have a quick thing. How do I feel like I traded today based on the execution, based on how I acted? It's not always about whether I performed well in that day or didn't perform well. It's about how well I executed that day. Then new trades today and observations, existing positions and daily observations, some quick notes here, thoughts on the market, key themes that are standing out, bonus notes. So again, this is kind of what I do on a daily basis. Ryan might do something different and he might organize it a little bit different, maybe use Notion or something like that. Basically, you want to just create a workflow that works for you. And this is one suggestion using Google Forms because I like it because it tracks everything in a Google Sheets right there for you and makes things really easily to collect that data. And again, you can scan this QR code and see this right there for you. And you'll be able to replicate that in Google Forms pretty easy. All right. So you have your data. Now what? Basically, you want to organize by trade, calculate key metrics, create visualizations, compare to historical norms, and then basically become a detective and draw conclusions based on your data itself. And once you have that data, again, collected through your trade input form or some other method, however you're tracking your data, you basically want to go ahead and analyze and calculate a lot of stuff we're talking about. So here are some key metrics to track. Basically, you've got your batting average, your win rate, what percentage of your trades are actually winners. You've got your average gain, average loss, your risk reward ratio, your max gain, max losses can be helpful to identify the outliers, and then also your trade duration. Are you holding your winners longer than your losers? And then you want to also analyze from a high level your equity curve. And Ryan, definitely want to hear your thoughts on that, about recommendations. But we'll get into that in just a minute. All right. So batting average. Batting average, like I said, is your percent of your trades that are wins. So if you have 20 trades over a period and 10 are wins, you've got a 50% win rate or batting average. If you have 10 trades and you have 3 wins, you've got a 30% batting average. And definitely something that's key is that many great traders have around 40% win rate or even less. And the difference between, how can you have a tremendous result and be a market wizard with a 40% batting average being wrong 6 out of 10 times? Basically, they're taking advantage of the asymmetric aspect of the market and letting their winners, really make strong gains for them, and capping the losers so tight. So yes, they might have a lot of losers, but all those losers are -3, -4, -5%, while their winners are +10, +15, +20, and then there's outliers that are even, a whole lot more than that. So one winner can basically pay for many, many losers. So again, it's not about being right, it's about being profitable and, using that asymmetricness of the market, of, using stop losses to cap your losses, to really, put that in your favor. And, it's not about the batting average. I think this is a common misconception, especially with newer traders, that you have to have an 80-90% batting average to have success in the market. Definitely not true, especially for our style. A lot of people here today are trend followers, and trend followers by nature are going to have much bigger winners than their losers. But, as trades are getting going and they're trying to enter a trade and enter a trend, there might be a lot of head fakes that could stop us out early on. But over time, if we catch, the right trends, that's going to pay for everything. And what's also cool about the batting average is it can be a good gauge for market health. So say you have a normal batting average of about 40-45%, that's pretty good. But then there's a period where it's 60-65%, where it's a new uptrend and everything's working. That gives you additional confirmation that, it's a good market and you should be taking advantage of it as you can. But if, you're just getting stopped out left and right and your batting average dips to, 35%, even 30%, that's again a sign that, take a step back. Maybe it's a very choppy environment. Things aren't following through and you want to be trading less. You want to be trading, more defensively, moving up stops more aggressively. So the batting average can be a great gauge for, what the market health is as well. Right. Anything you want to add on the batting average and how you kind of use it, to assess your trading?
Yeah, I think one of the things that I look at is just the last X amount of trades and how well those are working and how well I'm gauging the market condition. I think the overall batting average is pretty much for the most part on the lower end, because of swing trading. It won't be 70-80%. That's crazy. It will be 30-40% range, because you're testing the market. You're seeing if you're getting positive feedback on your existing trades, etc. For me, what's most important is the last 10, the last 15. Am I actually in line with the current market action? Am I on a losing streak of 5, 6, 7, 8, 9, 10 trades in a row, and I'm not able to gauge the market condition well? And then you adjust your position size, etc., according to how you're performing. So for me, it's overall, I think what you said, the number is going to be on the lower end. People aim for they really want strategies with 80% win rate, 90% win rate. This worked historically, so it has to work in the future, etc. But the reality of it is it's in the 30-40% range, and what's most important is how you're gauging the market now, not 50 trades ago if everything was aligning with your system, etc. So
Yep. And I see a good thought by Lisa earlier when it comes to collecting your data. She mentioned that it might be helpful to include, the time that you place the trade. Was it at 9:35? Was it at 10:30? Was it the end of the day? That can be very helpful as well, in order to go back and see, am I more effective trading early in the session? Like I know Ryan and myself, we like to trade early, or do I actually have better success if I wait, until the end of the day to place trades? So that's another really good suggestion, Lisa. And it's a good point that, whatever you find helpful, add to this form, and then you can go back and study it. But again, you don't want to make this too laborious because otherwise you're not going to do it. But you do want to collect some good data as well. All right. And I saw a question, why did we start with batting average? Because even though it's not the most important key metric, because we're going to be covering all of these. And it's an important metric to track, even though the average gain to loss ratio is maybe more important, but we're covering that second. So we're just covering all of these. There's no real reason why batting average is first. It's just probably the most common, so we wanted to address it right away. All right, so average gain, average loss. And I think this is really important, and I think something different that most people don't think about. I think you should track this both in dollars, percentage, and equity contribution, and I'll break down what each of those mean. If you've got a trade and you have 100 shares, and you make profits, which is great, and you make a $500 profit, that would be, your gain in dollars. But that gain in percentage on that position might be only 3% or 4%. And then if that position size is really low, your equity contribution might only be, adding to your actual portfolio 0.2% if you've got, a big portfolio. So the reason why you should track this metric in all these three different variants is because, like I said before, a big mistake I noticed early on is that I would have nice winners, but I was trying to diversify too much and keep my position size too small, and the actual equity contribution of those winners didn't really move the needle on my account, even though they were working well. So basically, by analyzing and calculating the equity contribution, the average gain equity contribution, you're kind of normalizing everything based on position size and actually seeing what moves the needle. Because a smaller position in HIMS or a TEM that goes up 50% for you might have equal equity contribution to a slower mover, a Netflix, that only goes up 10%, but you're willing to put 30% of your account in that because it's more of a liquid leader. So I think what my main point here is that it might skew your perception of your trading if you only calculate based on percentage or in dollars. So I think you should do all three of these to gain that different point of view for all of those. And Raya, do you want to explain that too? Because I'm not quite sure if I'm getting across exactly what I'm saying. But yeah, maybe from your perspective, you can explain that as well.
So, if you want the way I do it is more percentages, because of the fact that they're just easier. I know folks tend to gravitate towards dollar-based like goals. Hey, I'm making $500 a trade, or I'm making X amount of trade. I think that type of thinking for me at least didn't scale really well, because the bigger the amount gets, the more you're kind of pressured, right? Because you know that if your average loss is, let's say, $11,000, it just doesn't grow. In my mind, it didn't work for me. So I kept it, from a small account to a big account to managing money, all of that. I focus on percentages a lot more because it's just, easy, 3 to 4%, 4 to 5%, etc. So like, and then it gives you a ratio as well. Like if my average gain to my average loss ratio is always above, let's say 1.2, 1.3, I'm in a good space, basically. I'm doing something right, and over a series of trades, I will, come out on top, right? So it gives you that confidence when you do it from a percentage. In terms of the equity contribution formula, percent gain multiplied by position size, me personally, I tend to keep it a lot simpler than that. I just have, if I know my average gain over the last 15 trades is 8% and my average loss is 2%, time to press, time to really go, time to really put on position size, a really high position size, because something's working in the markets. My average gain to my average loss ratio is 4 to 1, right? When that skews back from like 4 to 1 back to a 1 to 1, where, okay, I placed a trade, 3% loss. I placed a winner, 3%. Now I'm in a 1 to 1 ratio. If I'm in that means the market is either my system and how I'm approaching the markets, that's level and it's choppy. So I don't have a real edge over X amount of trades again, right? So that's how my thought process goes. I keep things very, I guess, as a swing trader, you're looking at daily charts in a few months. From an analytic perspective, the immediate, monthly analysis and the quarterly analysis are always based on last 20 trades, last 50 trades, max, right? Because I want to stay in the moment in the market. But that quarterly, yearly analysis, that's where you can get into, what's my bigger, is my whole system working, right? From a bigger 30,000 feet perspective, is my system, performing the way I want it to? Why do my losses get increased when the market cycle is about to end? How can I tweak my market cycle system? Then you get into that true feedback, right? Which component of my entry tactic needs to be a little bit better? Was I a little bit, was I consistently late to trades on the charts. Where can I improve my entry tactics to make sure my entry, instead of $50, is around 48.50? I'm a little bit early. Can I do that consistently? So that's where the math comes in on a bigger quarterly, semi-annual, and annual analysis that you could do on your trades. So I hope that was helpful, because that's how I kind of look at it. So.
Yeah, I think it's great. And just quickly, to calculate your average gain and average loss, you basically want to sum up all your gains over a certain period. Maybe it's over a month sample size, and then sum all those up, and then divide by the number of winners. And very similarly for the losers, sum up all the losses, and then divide by your losers. And I'll also show you how to do that. I'll give you a quick preview. So risk reward. This is the next metric that we're going to talk about today. Basically, once you've got your average gain and average loss, divide the average gain by the average loss, and this gives you a sense of how much you're gaining per your average loss. So ideally for swing traders, probably 2-to-1 or a little bit more than 2-to-1 is ideal. For position traders, you want it to be bigger than that, because you're going to have a lower batting average, and you want your winners to really pay for those losers. So swing traders, 2.5-to-1, that's kind of what you're shooting for. Position traders, a lot bigger than that. And this is really critical for a longer term compounding and also building in failure, because it makes sure that losers can be paid for by your winners, and you just kind of want to find the ratio that fits your style and do the math and see am I on the right track, and that's kind of the goal of risk reward ratio. So again, to calculate this, divide your average gain by your average loss.
I'm curious to know if you guys have your numbers. If you want to put them in the chat, it would be nice to see what people are at over the last 5-10 trades, or even as a system. And if you don't know these numbers, today's the day to kind of go in and calculate it, because you're trading based on unknowns, or you don't really know what your outcomes and results are, right? So if you know them, definitely place them in the chat. If you don't, it's a takeaway for you to know exactly, at the very least over the last 5-10 trades, to know this. So.
Yep. Perfect. And then max gain, max loss. Whenever you're analyzing a system, putting on my engineering hat again, it's really important to look at the outliers, because that gives you a big sense of what's actually going on, and probably areas that you can either improve a system or critical things that you need to fix. Otherwise, something bad's going to happen. So, when it comes to trading, it shows your upside potential and risk exposure, and analyzing the outliers can really identify, the key things you need to change to improve your process. So think about what went really right for, a great trade that you had. And then also, if you've got a loss, maybe your average loss is about 3-4%, and you have a loss that was minus 12%, and it wasn't based on external factors or things you can't control. You really have to make sure you fix whatever, caused that loss. So again, this is where you'll make the most breakthroughs, especially on the loss side. If you improve your backside and improve, your risk management, it's going to really have a dramatic impact on your results. Rod, did you have something to add?
Yeah, in terms of max loss, that there's another thing. If you have a max loss rule, and then when you're doing post analysis, and you're not following that, that's another tell, right? That, hey, I set a 7%. I set, mathematically, we spoke about in our earlier webinars that 7% is where it kind of starts going really downhill for you, past that, and you're climbing uphill. So if you had that and then you stop following it and you place a trade and then market went into correction, you turned into this and that, that's also, again, that's the feedback loop that you're not trusting the system that you put forth, and you don't really trust the methods that you're following. And that in and of itself is, what causes many swing traders to not really make it to that phase 3 and 4. So if you're learning a system, you're learning Oliver's system, Stan's system, you're looking at the trade lab and how Richard's doing things, etc. And you'll see that all of them have that max loss rule, or have this type of, something that curbs their losses. Every single trader does that. Every single good trader does that, and I think it's really, really, really important, because I see many people, they go into a trade, my risk is 3%, and then a month later they're down 30%, and they're still holding the same thing because they still believe in the company all of a sudden. So a technical setup that turns into an investment is how is not aligning with your goal. So making sure these are when you do just analytics of max gain and max loss, it's also a check on, are you actually, committing to the rules that you set in your system, and are you checking off? Are you trusting the process of it as well? And many traders lack this part of it, where they have this rule, they have that rule, but when it comes to implementation, they turn into investors, right? So if you're a swing trader, position trader, stick to it, and this feedback loop will also, be something that keeps you in check again and again. So again, phase 1, 2, do it often. Phase 3, 4, consistency, and performance phase, you do it less because you have the numbers in the back of your head at the same time.
Yep, excellent. Also, I think this is an important metric to track, duration metrics. So for your gainers, how long are you holding them? For your losers, how long are you holding them? Ideally, winners are much longer than losers for both swing trading and position trading. I think, I like when my losers, stop me out the next day or even that first day, and then I'm out of the trade and can move that capital somewhere else. But typically, my losers are about two days or 3 days on average, and then my winners can be much more than that, more in the 10 plus range. So this is really important to track, and it gets you in the right mindset of a trend follower. Are you letting your winners work for you, and then are you cutting your losers as soon as they show you quick losses? Then after you've collected your data, and we'll show you the actual trade log in just a minute. After you collected the data, I think it's really helpful to do some different data visualizations. This first one is something I really want to talk about, and I think probably is new to a lot of folks. Then there's different graphs and charts you can make, equity per trade, per stock, percent gain per stock, to try to identify those outliers, performance versus setup. If you keep track of what setup you use for a trade, you could actually track your performance versus that setup and see which setup is more effective, and then lean more into those if those are working. Performance versus entry tactic, very similarly. And again, you can kind of get very creative at this and create different visuals that help you identify your strengths and your weaknesses. Here's the histogram performance. So this is really important, guys. So pay attention here. Basically, this is using a sample size of over, say, the last month. This here on the bottom is basically the percent gain on the trade. So you have, and then this here on the left-hand side is the frequency. So we've got 2 trades of over 25%. We've got 2 trades of about 10%, 11%, and so on and so on. So you've got a few really strong outliers over here. And then you have your stop loss hits over here, where from 0 to -4% is the bulk of your losses, where you've got 8 losses that are down between -3.75 and -2.5%, and then you have a few that get a little bit past your standard stop loss and hit a little bit deeper. So this is exactly kind of what you want to see for a good system. So this is a good example. You've got most of your losses right near the left side of 0. And then you've got some really strong trades that are really working for you and moving the needle. But there's still some area improvement. You can see this outlier trade example here, -10%. That's getting a little bit too far in terms of your stop loss. So you definitely would want to go ahead and investigate this trade and say, hey, what happened here? Did I not follow my rule? What rule could I implement to prevent that? So this is a really cool visual that allows you to identify, all your outcomes and visualize it and see, are you building a successful trend following system? If you are, all your losses are going to be pretty close to right near 0 to -4%. And then you're going to have some nice gainers that act well. And Ryan, anything you want to add on this graph that might be helpful for folks?
No, it's just it's a good visual way of looking at your winners and losers. If the left side is quite big, and you have towers on the left side and you don't on the right, that doesn't necessarily in this graphic mean it's a bad thing. It could mean that you have your winners are covering many of your losers in a big way. So in this case, Richard has the 10% gain, 11.25%. He has a 17%, 20, 21, 23, and 25. I think exercising and doing the math of it, coming up with hypothetical scenarios of the math, and saying, if I have 3% losers in a row, and then I have one 25% gain, where does my math stand in terms of what, if I started at equilibrium, let's say at $20,000 or $50,000, where do I stand? That type of, doing that manual calculation just once will allow you to take losses a lot more frequently, and you won't hesitate to take them because you know that your system's kind of searching for a big winner in the markets. And when you catch that, the times where you no matter what you do, what system you have, what type of market it is, and nothing's working, it will keep you motivated because you know the math behind your trading. And once you know the math and you've done it manually, and that's where for me it really, really clicked and helped me out a lot, and is when you know your math, you know the numbers of it. It gives you a lot of confidence when you take a loss and you're okay with it. You don't kind of hesitate. You don't second guess yourself. You know that you've calculated your numbers, and you know that once you have that, let's say a 25% gain, or like a hood moving 52% in 14, 15 sessions, all the ones, the smaller losses that were less than 5%, those are covered, and now you're really going for it. And I guess the gist of what I'm trying to say is it keeps you motivated when you're on a losing streak. And that's really, really important to have in trading, to not be demotivated or get down, especially when you no matter what you do, things keep not going your way.
Yeah, excellent. And I really want to. So first, I want to ask in the chat. Do you guys understand what this histogram shows and the value of it? Because I want to make sure. I think this is the number one visual that you should make on your data if you haven't already. So I want to see if there's any questions here before we move on. But this is really easy to make. I'll actually go ahead and show it here in let's see here. Let's stop here and share screen. And there we go. So this is the trade log template that we'll be sending out to you guys. These are 10 sample trades here. You've got buy date, entry tactic, buy notes, setup, cost basis. In blue is the numbers that you would have to enter yourself. And then everything else is kind of calculated for you. It calculates the R multiple, equity percent change, the percent change, the dollar gain as well, your portfolio value after that trade. And the visuals over here would be on the second tab, where this is portfolio versus trade number. And then this is the histogram right here. So let me see if there's any questions so far. Okay, clear. Awesome. And then these would be the raw metrics. And I'll go more in detail after we're finished the slides with this trade log. We've also built in here a little bit of cost basis calculator because I know people have a lot of questions. How do you calculate your cost basis if you have multiple buys? You can basically use this quick cost basis calculator to do that as well. So this is what we'll be sending to you guys in just a minute. And it includes the histogram. So if you change these trades to actually your own trades, it will calculate that for you. So let me go ahead and share the slides again. Perfect. All right. So this is the next nice visual that could be helpful. In addition to just seeing your equity curve over time, it might also be helpful to do equity curve versus the trade and see which ones really led to really significant moves higher in your equity curve, and analyze, was that a gapper setup when I normally mostly trade, breakouts? If so, maybe I'll look to master that setup a little bit more. So this can be helpful visual as well. And then this is kind of something I'm just starting to do, and this is something we'll build into the Deep View Journal feature, is analyzing your data with with AI and seeing what observations does AI make based on your data. This is something I fed it that same spreadsheet. It came up with different advice here. Let me actually zoom in. So this is a very simple prompt. I basically asked, analyze this trade log and come up with key takeaways and suggestions. You could have follow-up things. You can actually have it make visuals for you, make a histogram based on this data. And here's some observations. Risk management is solid. Most losses are capped under -3%, showing good discipline. Average days are 11 for winners, 11 days. Average for losers, 3 days. A lot of the setups I put in there were bases and trading bases, most trades. but the gapper trades had the best outcomes. So that was the observation it made that said, hey, maybe lean more into the gapper trades. Entry tactics, most over here. And, this might be near refinement. A lot of these entries didn't work out or were stopped out. So this can be really helpful to get a second look at your trade and kind of have a, trading coach that's built in for you. And you can ask it follow-up questions and just basically talk to your data. So I definitely recommend trying this out. Upload, once you've entered in your trades into that trade log, basically go ahead and upload it to ChatGPT, and ask it questions about, what improvements could you make? What are your most effective entry tactics, setups? What are key things that you think I should work on? Talk to ChatGPT, and I think it'll come up with some really good, feedback there for you. Okay, so let's keep going here. Then equity curve analysis. Ryan, you want to take this away and kind of talk about the importance of this and how you do it?
Yeah. So I would say this is the most important visualization of your results. In the markets, it's the source of truth. It cannot, lie or be deceiving, or there's no way you cannot not understand what you're seeing when you pull up your equity curve. So the first thing that you want to look at when you're analyzing what's happening is periods in the market when things are working for you. How does that equity curve look? And then periods in the market when you're seeing pullback, how steep is your equity curve pulling back as well. As long as you have, do that type of analysis, the second thing you want to make sure that you're looking at on your equity curve is a higher low, right? You want to, from one market cycle, in that market cycle webinar when we said, hey, the market cycle turns one, we want to position early in a market trend, and we want to get our positions on so that when that breath picks up and the initial floor of the market rises, our equity curve sees significant progress to the upside. And that's when you're going to the up, when you see that spike, the equity curve spike, that puts you in the driver's seat. If you're not seeing that initially and early in each market cycle that turns from a down cycle to an up cycle, that's something to work on. That's something, early positioning and the way you look at your system, that portion of it I feel is really key, because then traders fall behind. And once they fall behind, they start blaming the markets, they blame their system, they blame everything else but themselves, because they don't have a proper, market cycle system. The second thing on your equity curve is when you're off, 5% off of highs, 10% off of highs, you have to lower down. It serves as a mechanism and a feedback for you to take in that the position sizes that you're now putting on should be way lower than when you were seeing, an uptrend where one position works and you finance the other one in terms of progressive exposure if you're doing that, or when you're 5% off your highs, something has happened that's not the same anymore, right? So if you still want to be placing bets in the markets, placing trades in the markets, your position size has to reflect the progress that you're making on your equity curve. So what happens when you do that is that phase 1 and that phase 2 equity curve diagrams that we presented in the early webinars for the boom bust trader, you learn to curb your losses by lowering your position size, and then eventually when you do that again and again, you will then learn that there are times in the market that you don't or should not be trading as well. So all of these things, when you look at the source of truth for your trading, is your equity curve. Is it going up? Is it going down? Is it going sideways? Is it 5% off its highs, 10% off of its highs? It gives you a lot of information as to which components of your system are supposed to kick in, your position sizing system, where you lower it or make it higher, etc. As well. So at the end of the day, you have to take a look at this. There's no other metric, no math, there's no confusion when you're looking at your equity curve as to what's happening and what your inputs and how they equate to your outputs as well. So that's definitely, if you guys don't look at your equity curves and you're being told that, it's not a good way, etc., I would strongly disagree with that. It, for me, turned things around quite a bit, because I'm looking at the reality of my trading rather than thinking that things are going to turn around without me looking at my own results or my own outputs from the inputs that I make. which is the number of trades in the market.
Yeah, excellent. So especially if you're stage 2, a boom and buster, it's really critical, especially early uptrend. Guarantee that higher low. I think really think about that, and it's a great way to approach it. Perfect. Let's keep moving here. So this will be the focus more of next week, but I did want to mention it in this week as well, for those who don't attend the next one. So basically, after you've looked at your math and filled out your trade log and done your calculation, your batting average, all that, you want to select, your best and worst trades over the period, and, dive deeper into the charts and actually annotate your entries, your exits, your reasoning behind different things you do. Because like I said, this is what really turned things around for me when I noticed I was buying late when it was already a little bit extended. You want to spot, repeatable strengths and weaknesses, and, be able to make rule tweaks based on this. And we're going to dive deep into this next tomorrow in the next webinar, and show examples of, how to analyze yourself, how to think based on your execution versus the outcome, all of that. So this will be the focus of the next webinar. But again, picking out your, to start with 2 best and 2 worst trades. And that's really easy to find if you track your data and analyze those in depth. Again, the Pareto principle, analyzing just that select few will help you really understand where you're going right, where you're going wrong. And then if you have more time and are willing, you can do, your 5 best or your 5 worst. And probably focusing on your losing trades is probably even the most important thing, because capping your downside really can really improve your performance. So this will be the focus of tomorrow, but just want to mention here today. And then after you've collected all your data, have a spreadsheet, it's what can be awesome is you can do studies on your own data, your own entries, your own actions. And this is way better almost than doing a general study, because it's very applicable to you, how you act in the moment. It's based on your real trading. So what you could do is test sell rules, based on your actual entries. How would your trade performance have performed if instead of you use your existing trade rules, you left all of it on until it breaks below the 21 EMA for 2 closes? That's something you can test using your actual entry points. Testing stop loss rules. This might need a little bit of heavy lifting, because you have to see if you are stopped out or not, based on the charts. But testing if you move your stop loss to the low of the day instead of the 10 EMA or whatever your rule is, that can be a way to analyze if you're setting your stop the right way for the entries you like to take. Then testing entry tactics, setup effectiveness, again sorting and calculating your statistics based on a particular setup or entry tactic can really help you identify, okay, oops reversals are my most powerful entry tactic. I'm going to only focus on those from now on and really specialize in that in this type of environment. Or, I'm noticing gappers are my best type of setup. I'm going to focus on those. So these are all things you can do that can be really helpful and help you, jump to that next level, stage 3, stage 4. But it's only possible if you collect your data in a spreadsheet, keeps things organized, and keep things up to date. So I think this can be really powerful. And again, you can leverage AI to help you with this. But you can only do this if you have the data, is one of the key points I want to make. And then this is a good warning. With regards to doing studies, you definitely don't want to make sure you're overfitting. Market environment will have an impact based on which rules work best. So like I said, if you're studying sell rules, if you study it in a trending market where, of course, if you held a stock longer than you did, it would have really increased performance. You want to make sure you're keeping that in mind as you're doing these studies and thinking about, is this sell rule actually better that I'm testing, or did it just work in this month of this really strong year? So make sure you think about that as you're creating any tweaks that you do, so you're not overfitting to a certain market environment. So basically test tweaks, but identify changes that will help overall, over the long term, over years, not just based on one period. So this is really important. All right. So that's pretty much it for the slides. I want to jump into the spreadsheet again and bring that up. So let me know when you guys can see that. Right, you can see this, right? Yeah, cool. So this is the trade log that we'll be sending to you guys. These are basically example trades that you make, about 20 over the past, month or so since the market kind of turned around. We've got, key trades here, Palantir, Crowd, some stop losses, crowd strikes. These are pretty realistic. Some of these are trades that I took and got stopped out on. About I think 70% of these trades actually are losers, but you've got some really good trades in here of CRWV, HIMS, Tesla, Palantir, names that we've been focusing on. So this is pretty realistic. But you'd kind of want to go in and instead of these dummy trades, enter your own information. So what stock, was it? You'd enter the symbol here. Your buy date, you'd enter that. The entry tactic, you could kind of abbreviate things like I have, oops reversal, range breakout. You kind of set your own entry tactics here. Any buy notes for that trade, you'd enter here. Any setup that you like to use, you kind of put those there as well. And then again, you want to enter your cost basis on the trade, your shares, your stop loss and sell price. And then everything else is calculated for you based on, percentage of your portfolio. This is calculated based on your starting amount right here. And then over here is where the magic happens. We calculate percent change, equity percent change, R multiple. So you've got all that data there for you. And you can also put any additional notes you have. And this tracks the portfolio value after each of these individual trades. So after you've entered that, all that data, so you'd want to enter in your trades. And I'd suggest starting with about 10 or so. What you want to do is go over to the second tab here. And then this is where you'll see your actual trade metrics. So the number of trades, 20, number of winners, 7, number of losers, 13 here. Your batting average, the batting average for the sample set was 35%. Average percent gainer was pretty high, and that's because this market has been so strong, about 17%. Average loser is about minus 4%. The ratio is 4.8. And then this is the same metrics just based on equity contribution instead of just raw performance. So if something was weighted higher with a bigger position size, it would have more impact here. So average equity gain on a winner was 2.36. Average loss was about 0.5% of your portfolio. And then you also calculate the ratio here. It's very similar numbers, but you can see how position size does have an impact. And this might be more realistic numbers than this right here. Then we've got duration. So again, this will be calculated for you. Average day on winner was 7.5. Average day on a loser was 4.4. And then you'll also see some different graphs be calculated here. Now, one thing I do want to mention here is these are based on the sample size I have right here, which is 20 trades. If you have more than that, what you want to do is make sure you go ahead and tweak the different values to basically sum up the right things. So you basically want to extend all the calculations, drag the formula down right here. But this should be a good sample set to start with. You can go ahead and test out 20 trades and see how the visuals adapt right here. Over here is the cost basis calculator. If you've got different buys, say there's only 2 buys. Let me delete this. You've got, buy 1, 100, maybe it's even. So buy 2 is also 100. These are the 2 numbers. It calculates the cost basis right for you. And similarly for a sell rule, it calculates that for you as well. And you can take a look at the formula and see how we do this. Now, this is still a little bit manual, and this is a big reason why in DeepView we're very excited about the journaling aspect, because it will calculate all this for you and just output the trade analytics and distributions and visuals right here for you. But again, here are the 2 graphs I already talked about. This is plotting the performance over the course of the trades, but also highlighting the different setup that was used. So you can see most of them were up the right-hand side, base trades, but then you had 2, which were gappers. I think it was Sezzle and HIMS were gapper trades, and those actually were both positive, and you can see they were actually one of the 2 of the strongest trades that were made over the series of this example. So this can be a really handy visual, is tagging your performance by the setup itself, and you can go ahead and customize this, all of that. But this can be helpful to identify trends of improvements you can make. And this might say, hey, gappers are really working right now, or during this period, gappers really worked. So that would be the time to try more gappers or focus on gappers. So this can be a really handy visual. And again, the whole point of these visualizations are trying to identify outliers, key trends, and tweaks that you can make to your system from a high level to say, hey, this would improve your performance, focusing more on gappers, trying to get rid of these, stop loss outliers down here, down 9%, which is a CRWV gap down that, you had right here. That's the example. And try to get more of these, of course, these winners that trend there for you. So that's a quick walkthrough of the trade log. Again, it might take a little bit to get familiar with this, but work through it, and I think it'll be helpful as a foundation if you're not already tracking your stuff in your own spreadsheet. But this might be a helpful starting point for you guys. Engineers love details. Yes, I'll send this link out to this through email after this webinar is done. All right, cool. So that's a quick run through of that trade log. Again, test things out, enter your own trades right here. Start with 5, 10, see how these numbers change and how the graphs change as well. And that's pretty much it for today's webinar. Again, this is a little bit of a shorter one. Tomorrow will be a little bit more longer. We're going to be talking about diving into individual trades themselves, using some different examples, how to analyze your buy point and not judge it based on necessarily performance, but based on how well you executed your trade. So with that, I just want to remind you guys that for people who have pre-ordered the book, we have an additional bonus webinar on advanced pullback strategies that will be next Wednesday. It won't be at 11 a.m. That's a quick typo. It'll be at 6 p.m. Eastern, and you can scan here to submit your receipt of your pre-order to go ahead and attend those. I've had a lot of fun doing the breakouts one, the earnings gappers. There you go. Rye fixed it right there for us. I've had a lot of fun doing the breakouts bonus webinar, the gappers webinar. Hopefully that was really helpful for you. Went a little bit more into details, some advanced techniques. So if you've attended those, let us know in the chat what you thought of them. And highly recommend pre-ordering because you unlock these bonus webinars as well. All right, and then here's again the QR code to actually pre-order the Trader's Handbook. We're getting right down to it, guys. If you are going to order it, you've got to right now. Again, you unlock so much more than just the book, the educational course, the model books. All these are bonuses that will be sent the launch week. I saw a question about that earlier. And you also unlock those bonus webinars on advanced breakout trading, gapper trading, and the pullback one, which will be live next Wednesday. So definitely order your book today. And in addition, we're also talking a little bit about, unlocking for people who've ordered the book, a special community and special Q&As. So stay tuned for that. But just another reason to go ahead and order your handbook. Ryan, anything you want to add today to close things out on trading analytics before we move on to some questions here? And make sure you unmute your mic.
There you go. No, I think just make sure you know some of the numbers that we discussed today. Knowing them is most important. Download the trade log template that Richard just went over. Import some of your trades. Know what happens when you place, let's say your max position size is 17%, and then how many, if you have 5 or 6 losing trades in a row, how much effort it will take for you to recover from that. That will help you adjust your max loss or entry tactics. Know what's happening, especially in the last 15, I would say 10 to 15 trades. Always know that your current situation of your trading a lot better. Then and then you can get into the system-based stuff. If you don't know why you're trading poorly and you don't have any numbers behind it, you're just, again, like we said, are being random because your inputs are random, your outputs will also be random. So this webinar was all about putting some numbers behind your trading success or failure, and then these numbers will tell you the truth, whether you could be more successful than you are now, or if you're in a downward trending equity curve, how do you turn that around as well. So mathematically, math doesn't lie. The visuals that we spoke about with the histogram and the equity curve also are just the proof in the pudding that you need to take a look at for you to turn around if you're a phase 1-2 trader into a 3-4. And that's really been our objective throughout the last 8 to 10 webinars, to get you guys to transition to, at the very least, a consistency phase, and then with experience you'll get into performing well in the markets. Happy to take some questions now, Richard, if you see them in the chat, and they don't have to be, I guess, related to this topic, but we could do it just
I see one from John. How does the spreadsheet handle partial sales and add-ons? Really good question. So initially, if you start a 10% position in Palantir and then a 5%, you could add them as additional entries, additional rows in the spreadsheet. But if you're kind of treating them as they're the same thing, maybe the whole position gains 15% on you, then you could kind of combine them using the cost basis calculator. And similarly for cells, if you are doing multiple cells, you could, after you're done with the whole trade, combine those using the cost basis calculator to calculate the right averages for that. But really good question, John. Let's see here. Let's see. How could you handle different currencies? You'd have to come up with the conversion of the right stuff. That's a more complex thing for sure, but you just have to get the conversion numbers. Let's see. Go ahead. You see one?
How do we get the sheet? We'll email it out if you're on the list. For sure. I don't see any other questions. A lot of thank yous. Question is, are those winners full positions or partial sells?
The example I showed was pretty much full position sells. But again, you could use the cost basis. You basically, at the end of the day, if you sell half at 100, half at 95, you basically just have to find your average cost, the average sell. And to do that, you can use the quick calculator I have as a spreadsheet tab on that spreadsheet that I'll send out. Rye, you want to talk about what will be going on with DeFi journaling?
Yeah, much of what you guys see in the spreadsheet will be there, but also things like
and automated too, right? There'll be no manual stuff you guys do.
Yeah, so all you would do is import and sync. We'll get to it. Q3 of this year, we'll put out a very basic one where you can hook it to your broker, import your trades. We'll give you pre-calculated stats like we spoke about today. Also, these, we'll get into these visuals like we showcased with a histogram and success by setup, things of that nature. So it'll be a full-fledged module for your journaling. What you see out there, I would say is, just journaling tools make it a little too complicated. So we'll start with the very basics, what we feel are the most powerful metrics and stats, and then over time, evolve that module to be what folks, in terms of feature requests, etc., want it to be.
Yep. And like all modules, we'll take in user feedback and add stuff and continuously improve it. We've got that feedback loop built in. Again, that good concept. Time back to today. So
yeah,
thank you guys.
Also,
all.
anyone watching the stream today, it's May 17th. We're thinking of doing a meetup in New York, if you live in that area, on the weekend of the 31st and June 1st. So if you're interested, definitely head over to X. Just look at my profile. I retweeted. We're trying to gather interest for that, and if you're in that area, would be happy to meet up in person on, I think, Sunday, June 1st is what we're planning. We don't have a location just yet. We're just trying to gather interest.
Yep. And we'll sign books and all that stuff.
Yep.
Perfect. All right. Well, thank you guys all for attending. See you guys back here at the next webinar shortly. But again, make sure you pick up your Traders Handbook if you haven't already. The bonuses, I saw a question about this. A lot of the bonuses are coming launch week. So after the book is launched, we'll be emailing out to everybody who submits their receipt. The link to that is in the description of the stream, how to submit your receipt. And if you register your receipt, you'll receive those bonuses. You'll also unlock the educational course on the TraderLion website. All that will be happening launch week, so that's when you'll receive those bonuses. We'll break it down by day, and I'll send out an email really summarizing the bonuses shortly and letting you guys know the timeline for each of those. But there's a lot that comes with the book. It well more than covers the cost of the book. Again, signing up this weekend allows you to unlock a $100 TraderLion gift card by itself that more than pays for the book. And with that, you get exclusive webinars and just some great resources as well. So thank you guys all again. Definitely pick up your copy if you haven't already. And we'll see you guys in the next one. Cheers.